morning, ladies and gentlemen. Welcome to this special coverage of first quarter earnings that are upon us. And with us is the management of five-star finance business, which was very recently listed. Joining us in person is the CFO, Mr. Srikanth Gopalakrishnan. Good morning to you, sir, and a very warm welcome. Let's just first go through the basic numbers that we have in mind, and then we'll get into the details as far as the top line is concerned. Net profit for the first quarter rose 37% year on year to 252 crore rupees. As also the top line rose 39% to 666 crores versus 480 crores in the year ago quarter, and 616 crore rupees as far as the fourth quarter is concerned. So there is sequential as well as year on year growth. Mr. Gopalakrishnan, very welcome to the show. And let's look at how profitability has moved. What are your outlook as far as NIMs are concerned, and then we'll get into the physical expansion of the business. I believe you have as of now 547 branches compared with the year ago number of 386. But outlook on NIMs first, sir.
First of all, good morning to everybody, and thanks for having me on this show. Just to give a little bit of a perspective about our business model, we are an NBFC, and we provide secured loans to small business customers and self-employed individuals. Typically, these are customers who are graduating to the formal financial ecosystem, probably for the first time in their life for this kind of loan size. The only other alternative for them tends to be the money lenders or the unorganized institutions. From that perspective, there is a bit of ability to charge them the yields, because we are also taking a risk on them for the first time to this size. And if you look at over the last 7-8 years, which is the period of good growth for the company, this is a period where our net interest margins have also remained at a very healthy level. So as we speak, I think for the quarter of June, we had done a net interest margin of a little over 16.7%. It's about 40 basis points lower as compared to the previous quarter, and about 75 basis points lower as compared to the same quarter last year. The primary reason for the compression in the NIM is because of the increased leverage. So if you look at our leverage, it is at about 2.25x, and we are a very capitalized company. So we have been raising capital over the last many years. And post our IPO, including our IPO, which was not a primary issuance, it was only an offer for sale. So we had not raised any monies. So the game plan right now is to increase the leverage so that we can maximize the returns to the shareholders, which is why you'll probably see NIMs compressing. So our guidance to the market is as follows. While today some of these numbers are a little elevated, we will probably have a steady state spread of anywhere around 13%. And with a leverage at around 3.5-4x, we will have the net interest margins at around 15%, which will translate to a return on asset of about 6.75 to 7%. And like I said, at a 3.5-4x leverage and 6.75 to 7% of ROA will translate to a return on equity of anywhere around 22% or more than 22%. So that's broadly the guidance that we expect to operate in a steady state scenario.
Right. Srikanth, let's now take this conversation to the main business. As you've talked about, this is the formalization segment that you are into. Those businesses that are growing dramatically, and I want to get off from the yoke of the informal money lending system at very high rates, have now started to approach you. What is the average loan size that you have, and what has been the extent of loan disbursements in the quarter gone by compared with the year ago number?
Sure. So like I said, and you rightly summarized it, these are people who want to come out of the informal ecosystem, because there are three disadvantages in the informal ecosystem or the money lender ecosystem. One is obviously very high interest rates. They charge at least 2x of what we charge them. They also don't get to amortize their principal. So they only end up servicing their interest, hoping that at some point of time they will have the ability to pay the entire principal outstanding in a bullet and get back their property papers, which is very difficult, because to get 3 or 4 lakhs in a bullet is not easy for these kind of borrowers. And lastly, the practices are questionable. There are no fair practices as far as money lenders are concerned. Given all these disadvantages, these people want to move into formal ecosystem. That is where institutions like Five Star cater to their requirements. So the demand out there, and all of us know that this economy, as far as India is concerned, is a very huge market. Our offer documents, in which we have included a study by CRISIL, pegs this market at around 22 trillion. That's like 22 lakh crores. And all of us put together have not even scratched the surface. So there is a very huge opportunity out there. And we have the infrastructure to sort of cater to these customers. If you look at our disbursals, I think this quarter we have done about a little over 1,300 crores of disbursal, almost flat to the previous quarter, which is probably the best quarter during any year. The last quarter tends to be the best quarter. If you compare it year on year, like if I take back the last June, we were at about 1,130 crores. So that's another 7 to 8% growth in disbursement per quarter on a year-on-year basis, which is a very healthy number, because Q1 tends to be a little muted quarter for every financial institution, because you're coming off one of the best quarters in the year. So there's a little bit of a fatigue factor, which will cause this quarter to be a little muted. But having said that, it's nothing to do with the demand, because the demand is extremely high. We have the infrastructure to cater to them. So the guidance that we are giving to the market typically is a disbursement growth of about 25% or so, which will translate to an AUM growth of about 30+%. So that's broadly the guidance that we are operating in, which we have been giving to the market as well.
Two very quick questions before we get into the nitty-gritties of numbers. What is your average lending rate in the past quarter, and what is the area where you are seeing the maximum growth coming in from MSMEs?
Sure. So we are an institution which lends small ticket sizes. So we operate at an average ticket size of about 3.5 lakhs. So our loans largely range between 2 to 10 lakhs with an average ticket size of about 3.5 lakhs. We lend at an average interest rate of about 24%. So if you look at our portfolio yields over the last 7-8 quarters, or if you trace it back even prior to that, it would largely remain range bound around 24 to 24.25%. I think you need to look at this with a little bit of a context, because these are people who are coming from an ecosystem where they're probably paying north of 40%. So 24% is not something that they are very apprehensive paying, but they also understand that given the kind of risk that the company is taking, there is a little bit of premium that the company charges. So it's around 24% that we charge to the borrowers. See, we focus on service-oriented businesses which are extremely important for every common man to thrive. So these are businesses which are probably the last to get impacted in during any economic shocks, and the first to bounce back. So any kind of service-oriented business like a kirana shop, a petty shop, a flower seller, an electronic shop, a medical shop, a small eatery. So these are the last to get impacted and the first to bounce back. And COVID was a extremely good example. When the first sign of lockdown release was announced, these are the businesses which were allowed to open 2 hours in the morning and 2 hours in the evening. So from that perspective, they have a very resilient cash flows, which ensures that the asset quality of the company is also maintained at a very high level.
Yes. Right. Srikanth, I am sure you are in that lovely Goldilocks kind of a market where demand for such loans is extremely high, and given the digitization that we are seeing and the hunger for credit plus the formalization of economy is boosting the prospects of companies such as Five Star Business. Let me just give a little detour to our viewers. Five Star Business raised 1600 crore rupees in an offer for sale in November 2022 at a price of about 474 rupees per share. Of course, this money went to investors who had got in the company at an earlier stage, and none of the funds were deployed within Five-Star Business. Srikanth, given the hunger for loan, what is the fundraising plan that you have for Five-Star Business over the next 9 to 12 months, and what is your average rate of borrowing on the liability side?
So our fundraising, not just over the next 9 to 12 months, but I think over the next 24 to 36 months, it's largely going to be oriented towards debt. Like I said, our leverage is low. We have a net worth of close to 5,500 crores. So there is no necessity for us to raise any kind of equity. In fact, that was one of the reasons why our entire IPO was an offer for sale, because we had to put in 10% of the shares to get into the IPO, get into the market, and which is where, we managed to convince our existing investors. So while the money went to their investors, but it's also, good on their part to put their shares so that the company can tap into the public markets. So our fundraising on the borrowings, we have also been articulating our strategy, is that we want to have a very diversified borrowing base. So for this year, we would want to raise anywhere around 4,500 to 5,000 crores, and that number will keep going up, compounding at about 25-30%, given similar growth on the asset size as well. We want to have a diversified borrowing base. If you look at our borrowing base today, it's predominantly from banks, though we have managed to bring down the proportion of borrowings from banks from about 84% in June 23 to about 74% as of June 24. So our intention is over a medium term, not in the short term, but over the next 24 to 36 months, bring this down to about 50-55%. For this year, the intent is to get this 74% down to 65%. So which means we will be borrowing from banks, but we will also tap into other sources like capital markets, mutual funds, insurance companies, developmental financial institutions, both Indian and international. In fact, the first international institution after a long time that lent to us was IFC during this quarter. We raised 500 crores from IFC. We are also in talks with many other institutions. In Q4 of last year, we had NABARD sanctioning a 450 crore line to us. So the borrowing plan is very clear. We want to ensure that we have adequate liquidity on the balance sheet, which can be the fuel for our growth ambition. At the same time, ensure that this borrowing profile is not concentrated with a particular kind of a lender or a particular kind of a product, but ensure that we have a diversified borrowing base, which can also help us in our growth over the next 5 to 7 years.
Okay. Would you mention the average borrowing rate that you have so far, and where do you see it translating to 1 year from now?
Sure. So we have been borrowing at around 9.5% for the last, I would say, 4 to 6 quarters. The good part is, despite interest rates going up in the system, we have largely managed to keep our incremental borrowing cost within a range. So, from that perspective, our cost of funds in the book is also at an attractive number at about 9.65%. Our belief is, with the aim of diversifying our borrowings, we will probably need to pay a little bit of premium to capital market institutions. But at the same time, we are also tapping a lot into providing priority sector funding. So if we are able to use bank borrowings for the on-lending for priority sector, that is something that will give us some kind of a benefit from a cost of funds perspective. Hopefully, both of these are expected to offset each other. Even if not, I think the incremental cost, what we are guiding the market, is probably 15-20 basis points. It might go up. So in a worst case scenario, over the next 9 to 12 months, we are expecting our incremental borrowings to come in at about 950, 965 levels, which is something that the profit and loss account of the company can comfortably absorb. But while we are very, very focused on the cost of funds, today our bigger focus is to ensure diversification. And if that means we have to pay a little bit of a premium, I think we are ready for that.
Right. Srikanth, I'm very, very tempted to say that you have possibly the best spreads in the business. 9.5% is your borrowing cost. Let's take, a huge cost structure as far as your cost profile is concerned of about 5 percentage points. That's 9 plus 5, 14, and you're lending at an average of 24%. So that's a clear 1000 basis points of profit that you're enjoying. Is that true?
So our numbers show that. So 1000 basis points is pre-tax. So you knock off post-tax. We are making a return on asset of about,
Yes.
For the quarter of June, we made a return on asset of 8.23%. But what I mentioned is this is one of the reason for this is also
Yes.
the lower leverage. So as the borrowing keeps increasing as the leverage keeps going
Yes.
up, this number will drop a little bit. So the steady state, we are guiding the market for about 675 to 700 basis points of returns, which we are comfortable that we'll be able to achieve over a medium to long term.
Okay. May this journey continue as far as the spreads are concerned. Srikanth, now in terms of expansion, you have 547 branches compared with 386 a year ago. What is the game plan for the next 9 months in terms of physical expansion, and are you targeting any new geographies as well?
So our approach to physical expansion or geographical diversification is we will get into a new geography, we will put few branches there, understand the geography in terms of the credit culture, in terms of the employee culture, in terms of legal nuances, because we are also taking property as a collateral. Once we get comfort in a geography, which will typically take anywhere between 18 to 24 months, we will probably be one of the fastest to expand in that particular geography. But we are very, very conservative in the first 18, 24 months because we want a very clear understanding of the geography. Today, I would say about 94% of our book is in South India. We are very strong in Tamil Nadu, Andhra Pradesh, Telangana and Karnataka. And we have also expanded well in Madhya Pradesh, which has about a 5% of our portfolio. We are also present in Uttar Pradesh, Rajasthan, Maharashtra and Chhattisgarh, which are learning geographies for us. We are understanding the market. Maharashtra is showing signs of promise. So we have added more branches in Maharashtra. The next 3 years growth is going to be largely led by the expansion in the southern geography. Having said that, we will continue to keep investing in the newer geographies. One other geography that is probably in our radar is Gujarat, which we will enter at some point of time. So the next 3 years will be led by the southern geography, but we will have about 4 to 5 states ready, which can help us in meeting our growth plans beyond FY27. So while we are at about 547 branches today, we expect to open maybe another 150 to 175 branches for the rest of the year. These are largely on account of two reasons. One, the fresh branches that we open in the newer geographies and the existing geographies. What we are also doing is, as the branch becomes bigger, we also want to split the branches into multiple ones from a risk diversification perspective. So, those are also like an existing branch will get split into new branch, which means there is one other branch that is getting added. So put together, the fresh branches as well as the split branches that we internally call will probably be 200 branches during this year, out of which we have opened about 25-30 branches in the first quarter. So you will see an addition of at least another 160-170 branches for the rest of the year.
Okay, a couple of final questions, sir. We've seen this crisis built up in the banking and the NBFC sector for this war on deposits. All of you are hunting for fixed deposits, and retailers are headed for the market to get better return and probably a slightly better tax paying structure, although that's one thing that's a pain point in the recent budget. How do you see this war of fixed deposits for cheaper CASA getting aggravated or sort of toning down over the next 12 to 15 months?
So I don't know if I can use the terminology, but fortunately we are a non-deposit taking NBFC. So our entire liability is more of borrowings from banks, financial institutions, issuance of non-convertible debentures, primarily through the private placement route, taking monies from DFIs and all that. So we are not at all a part of the war on deposits. We have left it to the banks and the deposit-taking NBFCs. We are a non-deposit-taking NBFC.
So you're looking from the sidelines and enjoying the battle.
We are looking from the sidelines, enjoying the battle. We are also happy because the excess funds that we have from a liquidity, today we are able to place it with good banks at good rates. So if the rates go up, we'll be happy.
But we are in an interest, we are possibly headed towards a cut in interest rates, don't you think so?
Absolutely. Our belief is definitely we will see some interest cuts in the second half. Whether it's going to happen in the third quarter or fourth quarter is anybody's guess. But, the first sign of interest rate cut came in from Fed yesterday. And I'm sure at some point of time, RBI will but RBI will also take its call on interest rate cuts. Given that about 65% of our borrowings are variable rate, which are linked either to MCLR or external benchmarks like the repo rate and T-bills, I'm sure that, over the next 12-18 months, we are also going to be a beneficiary of those interest rate cuts in terms of lower cost of funds.
Okay, because your cost of funds will go down, and of course you lend at a minimum 24% as average lending rate. So a good place to be in this zone. Srikanth, I'm sure you and your team are really enjoying this scenario that's being built up into the economy.
Yeah, the economic scenario is good, but there are also supposedly unseen headwinds which the regulators keep flagging, like over leveraging and all that. So it's not a completely rosy picture that probably you're painting out. So there are tailwinds, there are headwinds. I think it's extremely important for an institution like us to ensure that we enjoy the tailwinds, at the same time have the necessary infrastructure, risk management practice to take care of the headwinds. So hopefully, with the guidance of our board, very strong management team that we have built, and more importantly, one of the most vibrant execution teams that we have on the ground, I think we should be able to overcome the challenges and emerge as one of the leaders in this segment.
Thank you, Srikanth. I hope the business progresses with a 5-star rating. And believe me, speak to any banking CFO, he would love to be in your shoes, given the NIMs that you enjoy and of course the spread that you have. Thank you so much for your time, and let's hope the 9-10 quarters from now on are equally good, and the new shareholders in the business enjoy very smart gains. Thank you for your time, and I hope you enjoy the conversation as much as I did.
No, absolutely, and thanks a lot once again for having me on the show. It's been a pleasure interacting with you.
Okay, this, ladies and gentlemen, was Mr. Srikanth Gopalakrishnan, the CFO of 5-Star Business Finance Limited, an NBFC, where NIMs, branch expansion, top line and bottom line have surged dramatically in the first quarter. The number reported on July 31st. Thank you so much for your time. Stay glued to Business Today Television. We are full of news as far as markets are concerned. The Nifty still 200 points down. The Bank Nifty down 100 points. The IT index has shed 500 points, and the Nifty 500 is down 0.5%. Thank you so much for your time, sir.
Infosys, India's second largest IT services company, which has for long symbolized India's IT prowess, has been hit by a massive GST demand notice. The IT bellwether has been asked to shell out 32,403 crore rupees as GST on services rendered by the overseas branches over a 5-year period starting 2017. The massive tax notice is 24% more than the Infosys net profit of 26,233 crore rupees in financial year 24 and 34% more than the net profit a year ago. The The tax notices have been served by both the Karnataka State GST Authority and the Directorate General of GST Intelligence, DGGI. According to the notice, Infosys did not pay integrated GST on import of services as recipient of services. The notice says Infosys set up branch offices overseas to carry out businesses and included the expenses it incurred toward those branches as part of export invoice from India. It adds that these branches in the company are each treated as distinct persons under the GST Act. The company refuted the notice saying that as per regulations, GST is not applicable on these expenses and that as per a recent CBIC circular, services provided by overseas branches to Indian entity are not subject to the GST. The company added that GST payments are eligible for credit against export of IT services and that it was in compliance with the central and state regulations on this matter. The combined tax notice for 5 years has raised concerns in the information technology industry, with experts fearing it could open floodgates of similar demands from other tech companies which have IT exports as their major revenue streams. Some comments on social media have even called the move tax terrorism on part of the government. Bureau Report, Business Today Television.
If you like the video, do like, comment, share and subscribe.
Good afternoon. We are here to discuss Q1 FY25 results of AEL. AEL's business portfolio comprises assets spread across energy utility, transport and logistics, direct-to-consumer and primary industries. The incubating portfolio comprises of Adani New Industry, airport and roads businesses, and the established business portfolio of primary industry vertical comprising business spreads across services, metals, commercial mining and industrials. AEL's incubation portfolio is consistently making significant strides in its operational and financial performance. AEL has recorded its highest ever quarterly EBITDA of 4,300 crores, supported by exceptional performance of incubating businesses with EBITDA of 2,667 crore. The contribution of incubating businesses to overall EBITDA is now more than 50%. During the current quarter, ANIL revenue increased by 138% to 4,519 crore and EBITDA increased by 3.6 times to 1,642 crore on account of modules exports. Airport business revenue grew by 27% to 2,177 crore and EBITDA grew by 33% to 682 crore. Total income of incubating businesses increased sharply by 63% to 9,342 crore, with EBITDA increasing by 107% to 2,667 crore. Profit before tax increased by over 200% to 1,552 crore. With this, the overall consolidated results for the quarter saw consolidated EBITDA up by 48% to 4,300 crore, consolidated profit before tax up by 107% to 2,236 crores, and consolidated income up by 13% to 26,067 crore. Coming to the project and operational updates of major businesses. In our Adani New Industries green hydrogen ecosystem, ANIL solar manufacturing business successfully operated at full capacity of 4 GW for both cell and module line. During the quarter, the module sales have increased 125% to 1,379 megawatt on year-on-year basis. ANIL wind manufacturing business has also received the final type certificate for 3 megawatt wind turbine. During the quarter, we supplied 41 wind turbine sets to customers. In our airport portfolio, for the first time ever, passenger movement at airports crossed 90 million on trailing 12-month basis. During the quarter, we added 39 new brands across all our airports, out of which 25 new brands were added in our recently inaugurated world-class terminal of Lucknow Airport, which can now cater up to 8 million passengers per annum. Additionally, Adani Airports added 8 new routes, 6 new airlines, and 13 new flights across all 7 operational airports during the quarter. The eagerly awaited Greenfield Navi Mumbai project is on track for completion in financial year 25. In our roads portfolio, during the quarter, we have constructed 730 lane kilometers, which is highest for any quarter since inception. The Greenfield Ganga Expressway project is progressing well and as per schedule. 3 out of the 10 under construction projects are now more than 80% complete, in line with the target schedule. Adani Enterprises continues to incubate new businesses and create sustainable long-term value for its stakeholders. Over the years, we have a track record of successfully incubating businesses across various sectors, which are currently leading companies in their respective sectors and delivering substantial returns to their shareholders. In line with above, the Board of Directors of AEL have approved demerger of food FMCG business of Adani Wilmar Limited. Adani Wilmar has become self-sustained, performing well and in line with forecast. With this, AEL continues its journey to unlock shareholder value.
APSEZ has kicked off FY25 with very strong financial and operating performance. While on the financial front, we have delivered all-time high earnings, operationally, we continued to add strategic ports and logistics assets to our portfolio. I thank all customers, team members, and other stakeholders for their unwavering support during our growth journey. Some highlights from the past quarter. Firstly, on the financial front, during the quarter, revenue was up by 21%, driven by strong demand across our ports and logistics assets. Our focus on efficient operations and financial discipline led to a 29% increase in EBITDA and 47% increase in PAT. Our net debt to EBITDA stood at 2.1x. Next, on the operating front, on ports, our cargo volumes continued to be ahead of the growth in all India cargo volumes. During the quarter, we handled 109 million metric ton of cargo, which is an increase of 8% year-on-year and is double the growth of all India cargo volume. We remain focused on adding strategic port assets to our portfolio. We have signed 2 new port concessions in Tanzania and Kandla and won a O&M contract in Kolkata. Our Vizhinjam port, which is India's first transshipment port and is equipped with South Asia's most advanced container handling technology, received its first vessel recently. On logistics, we continue to execute on our strategy to offer end-to-end transport solution for customers. Our rail assets demonstrated strong growth during the quarter. Rail volume went up by 19% and general purpose wagon volume was up by 28%. Our trucking business, which was launched recently, added 3 new customer segments to the portfolio. Also, our agri-silo capacity, which currently stands at 1.2 million metric ton, will grow to 4 million metric ton as we complete our current expansion projects. Recognition by rating agencies. Our debt ratings continue to see significant improvement. We are the first Indian private corporate infrastructure developer to receive the coveted AAA rating. CARE and ICRA have rated us AAA. Additionally, S&P upgraded its outlook on APSEZ to positive from stable. During the quarter, which demonstrates our commitment to financial discipline. Our efforts continue to be recognized across global forums. I'm very proud to share that 4 of APSEZ's ports were recognized in the World Bank's Container Port Performance Index 2023. These rankings consider multiple parameters, including productivity, efficiency, and reliability. Overall, our all-round performance in the first quarter positions us very well for a strong financial year, and we look forward to continuing the momentum in our business. We remain committed to building world-class sustainable transportation infrastructure that accelerates India's multi-decade growth journey and achieve our goal of 1 billion metric ton cargo volume by 2030. Thank you.
Hello and welcome. You're watching Business Today Television. I'm Sakshi.